Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is February 25th edition of Market Outlook. So the first thing I want to highlight is we were very concerned about sort of the sideways action around the 50-day moving average. And as you can see right now, what's occurred is we cleared it on 3 out of the 4 indices. So the Dow, the S&P, the NASDAQ is just about to take out its all-time highs. So 3 out of the 4, with the exception of IWM, which basically closed right on that 50-day, looks like it's resolving itself to the upside. So what I was concerned is taking out the on a closing basis the highs of the last 4 to 5 days, and we sort of virtually did that on a closing basis on 3 out of the 4 indices, but I would like to see a second close over the 50-day moving average, certainly in the Dow here and in the S&P, and some additional follow through in IWM. So things are definitely improved. It looks like we're potentially resolving ourselves to the upside. So if we drill down on a weekly basis, one thing you can certainly see is that we've done a hell of a lot better bouncing off of the key 50 and 200 week real motion indicators. And of course, the Qs clearly the strongest. And by the way, the other thing to note is our 50 week of real motion penetrating the 200. So that's showing some really positive signs here. Now, in terms of IWM, we're definitely still lagging here in terms of the overall indicators. And you can see we did bounce nicely off of the 50-week real motion indicator and the 50-week of the actual price action. And on a weekly basis, weekly, not daily, we're basically straddling the shorter term 10-week moving averages, with the exception of NASDAQ, which is clearly the strongest. All right, so again, it looks like we're getting a vote here of a positive move. Most likely, if this persists here for another day or so and confirms, we're going to get a test at least of the highs in the Dow and the S&P, and we'll have to see what it's made of from there. Okay, let's take a look at the at some of the other intermarket relationships here. So the first one that we want to take a look at is the S&P versus utilities. Right, this is our key intermarket relationship. And one of the things you can certainly see is that the utilities still doing better than stocks. Now, that's only 1 out of the 5 key intermarket relationships. So just to point this out, you can see right in here, right, that our utilities are outperforming. The red is under this moving average, the short term, the 20-day. So the utilities still outperforming. Now, let's take a look at some of the other key intermarket relationships. And across the board, pretty much they're improving. And so what you can see is actually wood versus gold, which is a good sign. More of economic expansion than anxiety seems to be prevalent. So with wood outperforming gold, that is more akin to good overall economics. Again, in the S&P versus gold, you can see now this week we've also improved there. So that's a positive sign. And no stress here in high yield debt versus bonds. Even though bonds did improve, high yield debt still doing well. And of course, when bondholders are willing to take more risk, what they're anticipating in terms of the yield spread between the safety of U.S. bonds versus that high yield corporate debt. That's a sign that anxiety or nervousness about the market is not not at the present really active. And in fact, it's the inverse. High yield debt strongly outperforming bonds. That's a positive sign. The other thing is that the S&P versus bonds again pulled out and is now approaching the recent highs over the last year. So that's a positive sign as well. So overall, big improvement across the board here over the last week and since that crash in early February. Now, in terms of volume analysis, we also went, one thing you can see, we went from a distribution situation where big institutions were distributing stock to the inverse. So on this bounce here, you can see in the Russells, 5 accumulation days, no distribution. That's pretty damn good. So this has been a definite flip, and it looks like the market is telling you that the bigger players are buying and following this move and bounce back up. And again, overall for the week, you can see the NASDAQ was up 1.5%, doing pretty well. And the other indices up decently, but a bit more marginal. So again, interesting bounce here. And again, over the last week to a week and a half or so, that sideways action might have given us enough energy to at least test or come close to testing the all-time highs. Okay, the next thing to take a look at and final is the market hotspots section. Couple things to note. You can see that Africa and the other leading areas in the market is oil, right? Down here over the last 5 days, 5-day leader here is US oil services, Brazil, which is definitely emerging market and commodity sensitive. So what's interesting is even though you've got this strong movement in oil and emerging markets, some of the other things that are commodity driven is like silver and coffee and gold miners put in a pretty poor week. So mixed message on inflation. So we're going to have to keep track of this emerging markets and see if they're going to be able to sustain their trend, and maybe inflation is sort of on pause and will kick in again shortly. That's unclear at the moment. So that's the bigger picture in the overall global macro picture, right? Strong stock trend led by emerging markets, and commodities sort of a mixed message. Oil strong, metals weaker, and some other softs as well. So let's stay tuned with that. Okay, so that's it for now. See you next week, and good luck with your trading.